The dust has settled on one of the biggest deals in the Canadian oil sands in a decade, and we have a clear winner. Cenovus Energy, CVE on the TSX, is the clear winner of this battle here. They've come out ahead, and they have probably the best growth prospects. So today we're going to talk about those growth prospects. Is this a better investment today? Is it a better stock than it was last week? What kind of opportunity does this bring to them? And where did this put them in the realm of Canadian oil and gas stocks? If you didn't hear the story, Cenovus came in, offered a bunch of money to buy MEG Energy. Technically less money than Strathcona had offered, but they offered much more cash. Thanks in part to this cash deal and the liquidity of the stock, the general size of the company, and probably a million other factors that haven't been publicized, MEG Energy's board said yes. And they said, yeah, you can buy the company. And that's where we're at right now. Now, shareholders on all sides have opinions, and generally Cenovus shareholders are happy. Strathcona Resources shareholders are kind of in the middle. I mean, they probably wanted to own MEG Energy, but they're also happy with the chance for a huge special dividend. MEG Energy shareholders are still mad that they're getting bought out in the first place, but some of them are happier to own Cenovus shares in Strathcona. It depends on the shareholder who you talk to. You can check like basically any comment section talking about this. There are opinions on all sides. Now, as somebody who doesn't own the stock in MEG, I don't have a huge sort of, horse in that race with, do I want Strathcona? Do I want Cenovus? Do I want to exist on my own? I understand all of the different opinions, but I am really interested in Cenovus shares because this is a company that's had a really troubled last couple of years. Really, they've had a real challenge in dividing their upstream and their downstream assets. Essentially, imagine upstream as the production and downstream as refining. And I know I'm oversimplifying here, but their upstream assets are like top tier, A grade. They've got decades of stay flat inventory. They can just run their production basically until oil is no longer required. They're good. It's an amazing asset to own. But it's diluted with their downstream refining assets that underperform consistently. They're not as profitable as they should be. They disappoint investors quarter on quarter on quarter. I have seen the same argument from everybody who's either been a Cenovus shareholder that's been burned, who maybe wants to own the stock but just can't buy it, or who does own the stock and is sitting on losses. They say, what the heck? Why are we sitting on these refining assets? And it's been a real weight on the company. If you look at a stock chart covering how Cenovus came into 2025 and what 2025 looked like for this company up until about the middle of the summer, it's bad. But if you look at the last couple of days, it's a whole different story. In fact, the last few days have been so good for this stock that it's basically back up, erasing almost all of the losses it's had in the last year, with a year-to-date chart that actually looks pretty good. So what exactly does this stock have going for it? What does the growth prospect look like? Well, to talk about that, I want to talk from one of my favorite analysts on Seeking Alpha, this guy called Long Player. Got it on the screen right beside me. It's so interesting. This guy covers just about everything in this industry. Really great. Check him out if you haven't. But he talks about one really interesting element that he thinks is going to make the stock much more palatable to hold, even regardless of any of those refining challenges in the not so distant future. And that's about dividend growth. Now, of course, Cenovus shareholders just took on a bunch of debt and diluted their positions to get MEG Energy, but most of them think that MEG Energy is worth it. Again, they feel like they won this deal. So let's see how the future could look really good for those of them that want a great dividend. And of course, we got a summary here. Basically, they're buying MEG Energy. It includes Christina Lake assets, which is right beside where Cenovus already operates. They offered cash mostly. They have a continuous acreage. There's double-digit dividend growth in the future. So, one of the interesting things I've seen argued by both Cenovus shareholders and by media personalities is that Cenovus makes sense as an acquirer for MEG because of geography. We talked about this last week when I covered the deal. Cenovus is MEG's next door neighbor. Now, just because you're neighbors to somebody doesn't mean you want to buy their house. But in the case of an oil sands producer, there are a huge amount of synergies that can be found. And right now is a really good time to be talking about synergies because we are looking at a pretty bleak next 4 to 6 months in the oil business. We've got OPEC finally releasing all of that oil that they've been holding back, all of that production. We've got the US trade, tariff wars, whatever you want to call them, dropping the price of oil throughout April. You remember the flash crash we saw there in the stock market, and sort of uncertainty just holding it down a little bit. And we've got increased production both in the United States, here in Canada, and principally down in South America, both Brazil and Guyana, who are producing a bunch more oil. All in all, price of oil is dropping. And while that's good for the general economy, it's really bad for these stocks. So right now is a great time to be finding synergies. It's generally the kind of time you would expect to see more M&A. And you've seen a lot of that across the board in the oil industry over the last little while. I mean, let's talk about Whitecap and Varen. Let's talk about even CNQ buying out just about everybody who was only tangentially interested in their oil sands assets. Why they own so much of now the Athabasca project. Basically, everybody sees the writing on the wall. Costs are going to be a problem, and soon. You're going to be looking at maybe $50 oil sometime this year. And that's me predicting based on what I've seen, but you could see worse, you could see better. Nobody knows, but it's going to be worse than it is right now. And cost synergies are the only way that these companies can really benefit. Bolting on an acquisition like this makes a lot of sense, puts them in a great position. You see from this chart that Cenovus put out, it's basically like Meg's assets are surrounded by Christina's, of Cenovus's Christina's assets. It's just, it makes sense. It makes a lot of sense. Contiguous makes sense for them. As we go down, you can also see a couple of other things. They're going to talk about how their designs work better than Meg's did, or, you know, whatever. We can get into the technical specs. Essentially, they're going to save money, and that's important. Now let's talk about what you probably care about and what I care about. Okay, so how is this going to impact shareholders and what do they care about? And this is something also presented by Cenovus last week. They talked about shareholder priorities. And they talked about their capital allocation here. And this is interesting. They talk about fully funding sustaining capital and base dividend at $45 WTI. They put that right there in the press release. Again, remember, based on everything I've seen, I'm thinking like $50 WTI is probably going to be the trough, the bottom of this potential dip this fall. But who knows? Pointing out that they can sustain their dividend at that rate is basically saying, hey, shareholders, you know how you trust us with your money? You've invested in our company. You trust us making these big moves, you know, taking on all this debt at such a challenging time. Well, we're going to be okay. If we talk about $40 oil, we're talking about US shale dying tomorrow. So there are a huge amount of other factors that would come into play before they have to worry about their dividend being cut, which is huge and is a big relief if you're holding the stock and you do not want to have your dividends cut. If you're somebody who's investing for that dividend, let's say you live off of it, or you're counting on it for an expense, or however you choose to run your portfolio, that's probably huge for you. They also talk about how this extends their ability to deliver double-digit dividend per share growth. Essentially, this acquisition allows future growth to be much stronger. And I think that makes sense. I mean, not only did Meg have a huge asset base, not only were they more or less on a positive trajectory. I mean, it's a challenged company for sure. Check out any stock chart of Meg in the past, and you'll see why shareholders there have been on the roller coaster of, you know, debt, acquisition, you know, rejecting acquisition, et cetera, et cetera, et cetera, et cetera. Right. But end of the day, the reason everybody wanted to buy them every time in the past is because they hold these great assets. Cenovus can hugely benefit from that. It's also in the part of Cenovus's business that seems to be the best operated. Right. We can argue all day long about their downstream assets, their refining assets, but their upstream assets have been run really well. It's been the thing buoying the company. So having those upstream assets reinforced by this is a good sign. It also talks about their highly capital efficient projects that generate value at $45 WTI. Again, that's like a relax moment. And then they talk about their long-term net debt target of $4 billion, which is apparently their goal to return approximately 50% of excess free funds flow, which they EFFF, to shareholders while net debt is above $6 billion. And then you get that up to 75 when it's below 6, and up to 100 when you hit that $4 billion net debt target. So they're saying, hey, look, we can't tell you exactly when, because of course they don't know what the WTI price is going to be. They don't know what different factors may come. They don't know what their costs are going to be in 5-6 months, but they can tell you that when their debt hits that target, expect that. When their debt hits this target, expect this. And 100% of excess free funds flow, so in excess of paying their debts, I assume, that's a lot of money. That is a huge reward. And of course, this could change depending on the future, but I think that means for shareholders that you can probably expect a huge boost to shareholder return. And Longplayer agrees with me here. If you read what he says here, he talks about how the accretive nature of the deal combined with the business growth possibilities will more than offset the reduction in money available for shareholder returns. Their last article worked to the idea that shareholder returns were now 100% of excess cash flow. Debt has to be paid before that happens again. There's an immediate drop to 50% being available for shareholder returns, like share repurchases. Investors need to remember that the last article also mentions the working capital situation. Change here is the working capital will logically need more cash as the post-combination company is larger. No, how that exactly shows remains to be seen, as the working capital growth could be part of the acquisition plan. So basically, there is going to be a pause, but then the future return will be higher. And they talk about that. They talk about the financing. And essentially, as we get down to the end of the article, this is what I think is the best depiction of what the real value is investing in these Canadian oil stocks right now. Cenovus just took a risk, but they did it in a way that means that they can survive the lows. And when the highs come, they will be amazing. We are talking a huge amount of value returned to shareholders. We are talking a huge amount of free funds flow. Imagine what this company is going to look like at $80 WTI, which, by the way, people are predicting as early as next fall. So 12 months from now. And if you are a longer term investor, if you're somebody who's willing to build dividend growth, you're looking at a pretty cheap PE, all things considered. With all the hype and all the growth in the last couple of days, you're still looking at a pretty cheap PE. You're looking at a company that can reliably continue to produce the same high quality asset for decades, that actually has additional assets that nobody understands how to value, which gives them even more potential to increase the value of the company without having to go out and acquire more, right? If they fix that downstream situation, which again, big if. I know I've watched the story over the last couple months, over years at this point. I understand that that's a big if, but if they can fix that, you unlock a bunch more value there. You unlock potential synergies on top of the immediately accretive one. So we say 150 million a year right now, up to maybe $400 million a year. Again, that is theoretically going to then go to pay down all that debt and then go to you as a shareholder. Like, there's all of this future value that's just been unlocked. And there are paths to get to a huge amount of dividend, a huge return. You could see them actually end up in, let's say, 5 years with a smaller share count, despite the dilution right now, thanks to share buybacks. Like, there are a lot of avenues to massive shareholder returns on this company. And their downsides are limited by the fact they own these great low-cost assets. So right now, I think Cenovus is a really interesting stock to look into. Does this fit your portfolio? Are you interested in the stock? And as always, I would love to hear your opinions down below. Do you like Cenovus? Are you buying the shares? If you're a MEG shareholder, are you taking Cenovus shares? Are you interested in the future growth of that company? Or are you looking elsewhere? Are there other stocks in the same area that you think offer a better potential return? I would love to hear your thoughts down below. And as always, if you like what we do here on the channel, you like the kind of stuff we talk about, please do subscribe. If you like this video, you made it this far, please like the video. And I hope I see you in our next one.